And now it is my great pleasure to introduce our first ESG in BC panel. It is an impressive group, and I'm looking forward to this discussion. First, Jennifer Coulson is the Vice President, ESG Public Markets for BCI, British Columbia Investment Management Corporation, which is responsible for investments for BC's public sector. Ms. Coulson oversees, among many responsibilities, BCI's ESG risk analysis for portfolio companies. Welcome, Jennifer. Next is Richard Manley. Mr. Manley, who I understand is joining us from Kent, England, is the Managing Director, Head of Sustainable Investing for the Canada Pension Plan Investment Board. Richard is responsible for integrating ESG considerations and risks across CPP's investment programs. Richard, glad you could be here, and thank you for working well into your evening. Our third panelist is Marcia Moffatt, Country Head of Canada for BlackRock. BlackRock has been a leader in integrating ESG data and risk into their investment processes for some time. As the country head, Ms. Moffatt leads all of BlackRock's business activities and guides the firm's strategic direction across the country. It's great to have Marcia with us. It's also nice to give a warm welcome to a fellow peer who has been so enriched since her time in law. Finally, the moderator for this terrific panel is Heidi Worthington, who will guide this esteemed group for the next 40 minutes as they share their insights on the shifting expectations of global investors and what it means for British Columbia. Ms. Worthington is Pacific Blue Cross's Senior Vice President, Chief Revenue Officer. In addition to always having her eye on revenue and innovation for the company, she's responsible for a number of strategic activities and operational teams at Pacific Blue Cross, including serving as the COO of their Work and Wellness Division, BCI. Once again, thank you for joining us today. On behalf of Bennett Jones and BCBC, it is an honor to launch the ESG in BC series. I'm very excited for all the conversations that lay ahead. Thank you. Over to Heidi.
Thank you very much, Radha. Before we start with our panel today, I would encourage our audience to find your chat function, and please do share any questions you might have with our panelists through that chat function, and in a few minutes we will get to your questions as well. I'd like to start with the state of the nation and where we are at today in comparison to the past few years. How has it been that investor expectations and priorities have been shifting, and how has that impacted the flow in capital markets? And I think, Marcia, we'll start with you with this question.
Okay, well, thanks, Heidi, and thanks, everyone. It's a real pleasure to be here and a pleasure to be here on this panel with Jennifer and Richard. So a little bit of background, because each of Jennifer, Richard, and I are coming at this from a slightly different perspective, with Jennifer and Richard being senior people within large pension plans. And we are an investment management firm and serve clients, including pension plans. And across the country here in Canada, in every province and territory. So, I thought I'd speak a little bit about what we're seeing and why this is so important to us and to our clients. Ultimately, we manage money on behalf of our clients, and we, as part of doing that, we're a fiduciary. So our clients expect us to think about what are the long-term risks that affect their investments. And when we come to the sustainability and climate conversation, we come at this from the belief that climate risk is investment risk and also a historic investment opportunity. So I start off with that because and we'd had some conversations about this as a group. Sometimes you come across other areas that are in vogue for a period of time, or that they're talked about a lot, but don't actually flow into how investors are placing their money. And that is not the case here, and we're seeing increasingly that upswing. So just before I get into flows and capital, when we're talking about, when we're saying that climate risk is investment risk, we like to break it down into two main categories. One is the physical risk, which is damage to real assets, buildings and utilities caused by extreme weather events, for example, which can impact valuations, raise insurance premiums, and so on. The other category that we like to talk about as a main category is around transition, and that's caused by the economy transitioning away from fossil fuels. So this is about the risk of being left behind as a business and not being ready for a new economy. So, a solar powered company would be a pretty low transition risk because we believe that that's going to be central to a net zero economy going forward. An oil company that's investing in clean energy and working to change its business model, well, that presents a lower transition risk than a company in the same industry who is maintaining the status quo. And not just a risk, but it's also an opportunity. So I just wanted to set that there. And then we do see a fundamental reallocation of capital. It is happening. I will tell you that, and this is certainly the case in Canada, certainly the case in BC, and in other parts of the world, that client interest is extremely high. It's part of virtually every conversation that we have with our clients. And then you're seeing actual capital flowing to these ESG-oriented strategies, especially climate. They've more than doubled in the past year. And, as we look forward and we speak to our clients around what their expectations are, we've asked them, looking forward to 2025, what do you expect? How do you anticipate your portfolio will change? What are your focus areas? And our clients have reported back to us, and this is globally, that they will double their assets in sustainable strategies from 18% to 37% of their portfolios. And more investors are seeking to customize their portfolios for specific risk preferences and also values orientations. And then when we asked our clients to rank their focus on E, S, and G today and in the future, 88% of our clients ranked the environment as the priority most in focus today. So that's a huge percentage. Now, regionally, and then I'll stop, Heidi, and pass it back to you or to the other panelists who have lots to say on this topic. Regionally, in British Columbia, I would say that British Columbia appears to be ahead of the curve in Canada in terms of incorporating these sustainability factors in your investment decisions and asset allocations. In particular, we see that universities, foundations, and endowments are really quickly evolving their investment practices. And the corporate pension plans a little slower, but it's very much a focus. And I think, Heidi, I'll pause there and turn it back to you.
Thank you, Marcia. And thanks for providing that additional context and framework for us in terms of the topic of what we're talking about, because ESG, I think, has become a fairly broad bucket of a whole bunch of different notions about how we're influencing sustainable outcomes. Richard, you had some thoughts, I think, on how you'd like to set the framework for ESG investing and if we're using the right terminology.
Thank you, Heidi. And thank you for having me here this afternoon as well. In terms of ESG, some of you will have seen from my bio that I spent 15 years before joining CPP as an equity analyst advising asset managers as to how to develop ESG strategies. And I remember very vividly, it still hurts, a PM once telling me, if you're the ESG analyst, there's a team at the end of the corridor you should have a meeting with. And I quickly concluded that if the portfolio managers didn't want to speak to me, I was packaging what I was doing the wrong way. And quickly decided that I wasn't doing ESG anymore. I was helping investors identify and manage 21st century business risks and opportunities. And I think one of the challenges we have with ESG is it's not immediately intuitive that this is an integral part of the business or the investing process, or this is something abstract. And I think the benefit of framing this as a 21st century business risk is that this new century has fundamentally changed the nature of being a corporate or an investor. We are now trying to meet the needs of almost 8 billion people. Those 8 billion people and the activities that they desire create real externalities. And in a digital world, awareness of the externalities of the human impacts of consumption is real time. It's changing customers' expectations of corporates. It's changing regulators' expectations of corporations. And if the boardroom doesn't appreciate that reality, there will be risk accruing in the company. The second consideration is that as we transition from the bricks and mortar or the industrial economy into the electron economy, corporates are now confronting asset-light digital competitors that are highly disruptive, pushing many companies to pursue every lever they have to drive financial performance, and occasionally miscalibrating risk. And miscalibrating risk at a time where the markets are increasingly intolerant of boards miscalibrating risk. So we have a macro and a micro driver that have effectively fundamentally made it more challenging and more difficult to lead a company in this century. So our expectations as investors, and I think our expectations of corporates, is if you seek to build a business or build an investment process that can adequately navigate and capture the opportunity of this macro reality, then you need to have a board, an executive team that is proactively embracing that reality and putting in place process and programs to identify and manage those risks. Now, we've taken that even further and now articulated that that is our expectation of corporations. We expect boards to ensure that executive teams have provided oversight and counsel to ensure that all material business risks are integrated into their strategy, their operations, and their disclosure to the markets. And that's the same for climate risk. We believe that corporates should be identifying it, quantifying it, and integrating those insights into their strategy, operations, and public disclosures. So I've found for the last decade, it's more helpful to engage in a conversation with business people and investors about what we do as managing 21st century business risks and opportunities. But occasionally, I must confess, I do periodically slip back to calling it ESG because it's a little easier to say.
So I'd love to pick up on that point from you, Richard, about the disclosures and about the need for reporting and the right metrics. Jennifer, I'm wondering if you could give us a little bit of what you've seen as the evolution in metrics and measurements around this space and how they're helping us keep things transparent and those organizations accountable to the commitments that they're making.
Mm-hmm. Yeah, it's a great question because there has been an unbelievable amount of change since I started doing this work almost 20 years ago. Where our ESG analysis, I mean, it was very qualitative. We maybe had a few data points to draw from, from company self-reported disclosure, supplemented with, government databases that we were able to tap into. But for the large part, it was a qualitative assessment. And I think you fast forward now, almost 20 years later, where there is real competition out there for different data sets and the ability for us to use a variety of different data sets. So it's really improving, every day. And I think we've gotten to the point, and similar to what Richard says, is we want it to be part of the investment process, part of the analysis, and that's how we have structured it. But I'm also pretty heartened by the fact that, the data has improved so much that we've been able to build ESG data into our quantitative funds as well. So not only including it in our fundamental analysis, but the tests for data quality and the link to performance has been strong enough that our quantitative fund managers have felt comfortable including ESG metrics in those funds. So I really take that to heart. I think as well, some of the evolution that we're seeing, more artificial intelligence, usage when it comes to ESG data collection and, what that can tell you in terms of, sentiment. So again, going beyond just company reported data, which is obviously really important. But supplemented with other aspects of data analysis. So that's been relatively recent as well. So, I think there is obviously concern that there's too many metrics out there, too much information. And I think we had to get there before we start to really converge. And, we support a sector-based approach to this work. You just cannot look at the same metrics for a bank that you do for a mining company. So in large part, we take guidance from SASB, which is a very industry-specific set of recommended disclosures, as well as TCFD specific to climate. So I think you're seeing a lot of convergence, particularly from the investment community, around these two particular frameworks that can really help guide disclosure. And I guess the only other thing I would say, I mean, this is, even though it's improved a lot, there are still imperfections. We still struggle with small cap companies, for example. We have both a Canadian small cap mandate as well as a US small cap mandate. We still struggle a lot to get ESG data from those companies. So there is still a bit of a size aspect to the current disclosure that we see. And I think it's important for people to recognize, even if we do converge around, specific frameworks of disclosure, that does not mean that everyone is going to look at ESG the same way for a company, right? You are still going to have people interpreting that data differently. And I think sometimes there is an assumption that, oh, well, we just need a common framework so that everyone, sees how great we are. But you're still going to have people analyzing that data and potentially coming to different conclusions. And that's generally the way the market works, right? You need a variety of opinions feeding into the views on that company. So there's just a few thoughts for conversation.
Thank you,
Heidi.
Jennifer.
Can I jump in there and just add a couple of thoughts? Okay,
yes, absolutely.
Thanks. Yeah, I would agree with what Jennifer is saying here. It's been, whenever you have a newer space and it's taken seriously, there's a period of time where you're looking to coalesce and rally. And I think we've made a lot of progress over the last 12 months around the investment community rallying around a specific set of standards. And so, for all of those listening to this, I would take the disclosure pieces very seriously. I know that through both our work on the investment stewardship side, which is where we speak with public company management, and I will also do that through the Canadian Coalition for Good Governance, which engages with boards of directors. We get a lot of questions back around being overwhelmed as to what kind of disclosure is appropriate. So it's not perfect yet, but we are making headway. And so I would agree that it's around TCFD and SASB. And then it's really thinking about what are the material risks, which was what Richard mentioned at the top of this session, the material risks to the company that should be disclosed as you look forward to the future. On the, so I would just, my message there is it's evolving, take it seriously. We don't have all of the answers because it's not possible to go from a place where there weren't these disclosures to suddenly them all being in place and tied up in a bow. And also I would encourage, and I hope that most companies are now moving off of this, but we still do see it where people put this in the bucket of corporate social responsibility. That's not what this is about. This is around investment risk and disclosing, making appropriate disclosures to your investors. The other piece that I would mention is there is absolutely a wealth of data offerings. To add a little color to what Jennifer was saying, we have an investment management system that we call Aladdin, and we put in there all sorts of data points so that our clients can analyze their portfolios. It's quite a sophisticated client base that utilizes Aladdin. And so we have in there a range of data offerings around sustainability metrics. And I got an update on how many, because we're constantly adding to this, and we've got over 2,000 in there now. And it's through, these come from different sources, through MSCI, Sustainalytics, Refinitiv. And so what I'm saying is the analytics are there. Investors are looking both at your disclosures and the analytics that they have available to them, and it's getting better and better so that we can actually make these more specific judgments and assessments. So I just wanted to add a little color there, Heidi. I'll pass it back.
Well, maybe I'll just pull a little bit more on that thread, Marcia, because one of the comments that you made in our earlier discussion was how things have evolved from what really started to be the divestment approach, so taking capital away from the offenders and leveraging this as a tool to really foster innovation and sustainability. And maybe you could speak a bit more about that.
Yeah, I would say, I would characterize the divestment approach as a rudimentary approach. That's where, you say, okay, I'm just not going to have any oil and gas producers in my portfolio, which is I believe increasingly recognized as both a rudimentary approach and not an approach that's going to get us to where we need to get to. What we do see some of that where a client wants to have an exclusionary approach, but what we're seeing increasingly is understanding that we're in a transition, and that companies that are thinking to the future and adapting their business models to the future are the ones that are going to be successful. So, for example, strategies where you've got best-in-class companies from each sector, and you look at and you overweight the companies that are investing in clean energy, for example. It's really assessing, okay, which companies in particular industry sectors are going to be better positioned to benefit from the transition to a low carbon economy, and then underweighting those that might not be as well positioned. There's also, this goes across a whole spectrum. We also see a lot of interest in, we have for probably 5 to 10 years now, increasingly over the past 5 years, in clean energy. And I know BC is well positioned in that regard. So, that one in terms of wind and solar, I would say that's fairly well developed now. But more recently, we're seeing an interest in, and we're partnering with others around funds that are looking at decarbonization solutions to help accelerate the efforts. So I'll give you an example and that's actually in the private space. And I'm sorry, Heidi, I'm going all over the place because there is just so much to talk about here. So, for example, we partnered with Temasek, which is a Singaporean-based sovereign wealth fund, to launch a series of investment funds that are focusing on decarbonization solutions, and that's all in the private space. So what I would say is it's getting a lot more sophisticated, and I would break it down to there are more niche strategies, and then there are the pieces that are getting into the core of an investor's portfolio. Historically, and still somewhat to date, you're seeing the strategies off to the side from the investor's core portfolio, but increasingly we're having conversations around bringing, especially climate again, right into the core of an investor's portfolio. And much of that is being done through what I would call an ESG aware strategy, where the portfolio is tilted towards companies that are more heavily investing in ESG, and maybe in those sectors, because I think there's a greater recognition that we are in a transition, and that it's not so simple as saying I'm just not going to invest in these companies, because we actually all have to be part of this transition. And some of the companies that have been larger emitters in the past, they are part of our solution for the future, and are often very well placed to execute and put additional R&D towards evolving their business model.
Thank you, Marcia. Your comments have sparked quite a few questions from our audience in the Q&A section, and I'd love to get to some of those, but I'm just going to do 2 more questions for our panelists before I go to our audience questions. And that's shifting a little bit off of some of the sectors, which we'll come back to, but talking about Canada and then BC in particular. But from Canada's perspective, where are we ahead and where are we behind? And what are our opportunities? Maybe, Richard, I could ask you to speak to that for us.
Yeah, I would say when we look at this in a global context, it is worth just reflecting for a moment as to where the genesis of external stimulus for corporates to report ESG really came from. And I'd say really that dates back to the very late 90s, early 2000s, where regulation was put in place in Europe requiring asset managers to report how their portfolio companies were managing ESG risks. So it's taken a little over 20 years to get to where we are today. But what I would say is that the impetus for this has historically been relatively European-centric. Europe also has now progressed regulation with respect to what it believes issuers should be reporting. So at a high level, I would say that Western Europe is relatively progressed. And another thing to consider is if you wanted to guess whether a company scores highly or less well on the public raters, the first things to consider is how large is the company. Very large companies typically report more. Where is the stock exchange that it's listed? Because where the stock exchanges require ESG reporting, that typically also lends to higher scores. Who are the primary shareholder base, where you have more of your shareholders are signatories to something called the Principles for Responsible Investment. Engagement with the portfolio companies typically leads them to be more progressed. And the last thing to consider is how hairy is the industry for ESG issues. It's quite normal for industries that have red hot health and safety considerations or environmental considerations to be more proactive in reporting how they manage these than potentially more benign industries. So in that context, Canada has not seen, I'd say, the same level of external influence to report that we've seen in Western Europe. But I would say Canadian companies in the industries that have high E and S externalities to manage are typically very competitive versus international peers in terms of environmental impact and health and safety. The listing requirements in Canada typically mean that corporate governance is relatively competitive in a global landmark or global benchmarking exercise. But I'd say one opportunity in the years ahead will be for Canada to lean in terms of more progressive climate reporting. And maybe if I could, Heidi, just quickly building upon one of Marcia's early comments, just being conscious of time. One of the things that Marcia discussed was public or equity investors engaging with public companies with respect to how they are managing ESG risks and hopefully compelling them to perform better versus divestment. I think there's now growing awareness among civil society and some of the NGOs that pushing asset managers to divest doesn't yield the desired outcome of compelling companies to perform better. I do think one area of the capital markets that's not been as particularly focal for civil society and NGOs has been investing activities in credit and lending. And importantly, the difference between the two is typically the credit and lending is directly putting cash in the hands of a corporate. We have started to see over the course of the last 12 months now the negotiation into future interest rates of performance requirements for the company to improve its performance on ESG metrics if it seeks to see lower interest rates in the future. And if they deliver deteriorating performance, the cost of their debt would go up. And I would expect in the next 12 months, even for private companies, they are more likely to see either their lenders or their bond investors demand improving performance on ESG metrics when they are negotiating future issuance terms. Hopefully that covered the question.
Yes, thank you, Richard. I think you addressed both that public, larger public entities, as well as the smaller privately held organizations who can be part of that innovation tool set for creating sustainable economies. And with that, I'd like to pivot, because we have quite a few of those in the province of British Columbia. And for those in our audience, obviously, who are very keen to hear our panelists' thoughts on how BC in particular is doing, what are the opportunities that we can seize here at home? Jennifer, I'm wondering if you could speak a little bit to this.
Yeah, I'm certainly closest to it geographically, and I would also just build a little bit on what Richard said as well, because it's a summer opportunities for Canada, but also BC specific, and certainly within Canada we do have the opportunity, I think, within this transition finance space. Where because we are obviously a resource-based economy in many ways, and we need to help those economies actually make the transition. And so specifically raising capital that allow companies to make that transition happen faster, I think is a huge opportunity for Canada, but obviously an opportunity that many in BC could also benefit from. Certainly, we've seen some pretty interesting companies come forward on carbon capture and sequestration, R&D, and getting to the point where these projects are reaching the scale that they could really make a difference. So I think that's really promising. I'm definitely an optimist in many of these areas, and BC would have an amazing opportunity, I think, to really showcase some of the innovative models that companies are structuring with Indigenous peoples, right? Like there's new business models that are popping up. That allow Indigenous people to participate in a much different way, with equity stakes or other types of structures that really ensure that the benefits are equally shared. So I think that's a really big opportunity. Obviously, we have a mining industry here in BC as well. And what do you need for the growth of EV vehicles? Well, we need a lot of those minerals, whether it's copper or nickel. There's estimates of huge shortages in some of these metals. So I would see that as a pretty big opportunity for BC, and of course a really fast growing clean tech sector as well here in BC. I mean, the last numbers that I saw, it was worth $3 trillion per year, over 270 companies within the clean tech sector. I'm not sure how many people are actually aware of that. So that's a huge opportunity to get that message out and become a place to attract capital for sure.
Thank you very much, Jennifer. I'd love to just take our last few minutes to take some questions from our audience this morning. I'm just going to pull on this one here because it taps in a little bit to, I think, what all three of you have touched on in different parts of your comments this morning, which is, how does the ESG risk profile vary for the knowledge economy versus the more traditional natural resource-based economy? Would any one of you like to take that one?
I can give it a go. It's very helpful, I think, now to position this as 21st century business risk. You couldn't get hacked in 1990 because the internet and email didn't exist. But in the knowledge economy, it's very clear now that IP, data security are absolutely critical to preserving license to operate. So I think, as I think both Jennifer and Marcia have touched on, one of the benefits of the SASB reporting framework is the industry-specific nature of it. It focuses on what is material to the industry. In the more industrial or resource-based industries, it's very clear. It's about health and safety. It's about stakeholder engagement. It's about the environmental impact of those activities. As you move towards a knowledge-based economy, in a very large part, it's about talent. And it's about ensuring that the integrity of the data infrastructure and preserving customer trust, it is possible to ensure that you don't undermine the long-term intangible value that is integral to supporting the valuations of many of those businesses.
Thank you, Richard. I see that we are getting, oh, sorry, yep.
Sorry, I was just going to quickly say, I mean, I think that the human capital piece is really crucial. And certainly, you know, over the past year, we've been talking to companies more and more about human capital, just in the context of COVID. So just wanted to put that out there. I mean, COVID has really shone a light on human capital in particular, and that obviously affects, you know, more of the companies that Richard was alluding to.
Yes, thank you. That broader definition, I think, of ESG, which often is thought of in the climate terms, but is certainly the human dimension and where people would like to work and where they would like to invest. Obviously, those are dynamics that are so important to consider. And I notice we are close to time, and I would love to give each one of our panelists an opportunity to just give us some of your last thoughts before we shift on to the next part of our session this morning. I think what I'll do then is pass to Marcia for you to bring us into the home stretch with your last thoughts for our audience.
Sure. Thanks, Heidi. You know, I just reiterate that you take this seriously, not just climate, but also, as Richard and Jennifer just touched on, around the human capital and privacy and so on. These are very large themes, really important to investors. My last thought is, you know, I don't want this to all be around the risks. There's a huge opportunity here, and we're looking for investments. You know, some estimates say that 50 trillion of investments are needed to actually achieve net zero by 2050, and there's a massive funding gap, 60 to 85%. So we can all be part of the solution here. And so what I would like to leave with this group is that there's a large opportunity for our companies in Canada to be a big part of the solution. Thanks, Heidi.
Thank you very much. And Jennifer? Well, I think that was well said by Marcia on the opportunity side, absolutely. And we focus more and more of our time on that. I guess, you know, my parting words would be around, you know, this can be an overwhelming space in many ways if you're not, you know, in it kind of day to day. But it's really quite simple when you break it down and you think about what are those strategic risks and opportunities that our business faces, right? So it doesn't have to be such a daunting exercise if you really focus in on those key issues that will help drive your business forward. And then, sorry, I had one other final thought and it completely escaped me.
Well, that's okay. I will pivot to Richard, and then if it comes to you, Jennifer, just flag and we'll finish with you. Richard, yes, of course. And Richard.
Yeah, thanks, Heidi. So I'd say three things. The first, if you're not telling your story, someone else is telling it on your behalf. The raters are taking your public filings, they're scraping the data off the internet to generate a score for you independent of your corporate communication strategy. It's got to be, I think, now an opportunity for every business to get ahead of that reality and tell their story in their own words. The second point I'd say is that ESG is not really an appraisal of the business. It's an appraisal of its leadership. It's an appraisal of its culture, the board, the executive team, and how they set the tempo in the culture. So this, I think, is really a reflection of the people that are in the audience today. You know, if you think you're running a great business, you know, lead it and manage these issues as a great business. And the last point I'd make is that, you know, 20, 30 years ago, great businesses were financially sound and operationally excellent. Today, the bar is higher. You need to be financially sound and operationally excellent, but you need to have a culture that is proactively identifying both these risks and these opportunities to have certainty of access to capital and the ability to create long-term shareholder value. So in essence, why have just a good company when you have the opportunity to have a great one?
Wow. Well, I think, yes.
Sorry, it came back to me.
Of
And
course, Jennifer.
it was just to say that, I mean, you hear from us that represent, a certain part of the market, but really, if people aren't aware yet, that it really is all providers of capital that are starting to look at these issues. There are sustainable finance teams that are built out now in, every financial institution. So, whether it's equity investing, whether it's underwriting, whether it's lending, this is impacting, all parts of the market.
Thank you very much, Jennifer and Richard and Marcia, for all of your expertise and experience that you bring to the panel this morning. I found this not only to be insightful, but also inspirational. So what a great way to kick off the series. Thank you very much for your time. And I'll pass this back over to our leaders of the BC Business Council for the next part of this morning's session. Thanks again.
Well, thanks so much again to all of you. What a great conversation. I've had the chance to talk to Richard and Jennifer and Marcia over the last number of months, and I think I've got 7 pages of notes on it, additive information and knowledge that they've shared with us today. So thanks so much. Heidi, what a great job in leading us through this conversation, which, as we can see, is really complex and covers off so many aspects of not just business, but society and how we come together, including with governments and community.